All right, here we go. I will, I guess, I will switch on my video here as well. And a couple of people coming in. Hey Jeff, how are you doing? So, share that in a moment. And I think everything so far is looking pretty good. Awesome. I'll put this up. Andale, that looks good. So, yeah, we'll give it a few minutes before we really dive into it. I'm going to keep it pretty short and intense today, and I would enjoy some interactions where possible, but I also understand if you guys just want to check out what I'm talking about and kind of lean back. Okay, we'll also try to keep an eye on the chat and the comments on LinkedIn. So I'm experimenting still a little bit with all this live stream stuff. So right now it should, in theory, be live on Zoom right here and on LinkedIn. Somewhere in the feed, you should see that I just went live and also pushed it into the YouTube channel where I'm already super famous with like 20 subscribers or something, building that. But you got to start somewhere. Um, all right. If there are any questions that you guys have, hey Chase, good to see you. Hey Patricia, and any questions that you already know you have. There's also this Q and A obviously section, or just drop them into the webinar chat. It should be active so that everybody can use it. Yeah, I think I will just go ahead and start going through the slides. No, what do you want from me? Here we go. So, topic today, obviously, new rules for wealth advisors. I think it's a pretty hot topic right now, mainly because of a couple of things that are going on. Obviously, we talked about it before that there is quite some transfer of wealth happening. So it's not like if you're looking at the wealth advisor world, there was a couple of young guys out there as well, but in general, a lot of wealth advisors that are out there are definitely rather at the second half of their career. Let's put it like this, and the client base also seems to be a lot of baby boomers, and there is definitely a big transfer happening, right? So why is that important? One of the main reasons why this is definitely important is because people that are a little bit younger, also on the high net worth side, I just did this poll yesterday with a couple of insights. Um, hey Jamal, good to see you. I did a couple post yesterday. I think it was a little bit with some insights that we dropped in there, especially in the ultra high net worth world. Surprisingly, there's a very strong trend towards like do-it-yourself investing, right? And I will touch on that a little bit. But the reality is also that if you're going to Schwab, if you're going to whatever, BlackRock, Blackstone, not so much, any of those bigger platforms, you you can select most of the products that wealth advisors will recommend by yourself, right? Then, and you don't, for the results that lots of people getting through the wealth advisors, they're kind of questioning if it's worth paying a wealth advisor, right? So one of the things that I wanted to look at today is, okay, so if you're investing, how do you actually select investments if you would do it by yourself, or also if you would do it as a wealth advisor for your clients, obviously. Um, and there is a lot of, let's say, resistance in the wealth advisory space to do things that are not just like the things that you do on the Schwab platform. It's kind of fascinating, obviously, but the reality is most people, like, let's say there are other platforms, but Schwab or TD Ameritrade, definitely the bigger one. Um, the things that are listed on the Schwab platform are mainly, obviously, if we go into the to this slide here, are mainly what you would call traditional asset classes, right? And that is kind of the whole thing. Where I'm a little bit going today is okay. So why think in asset classes, right? If you're looking, and that's the question that I'm posing here. So what is merit based? What does it mean in the investment world? It basically means that you're not thinking in terms of asset classes, right? So it would actually be interesting to turn this chart, and maybe I will do that, and say, okay, so what would this look like in terms of in terms of merits, right? So if you're not thinking in asset classes, what would you think, and how would you categorize it instead, right? And like the way that we look at the world is okay. There are actually two types of two type yeah two perspectives on what you how you should categorize your money in general. Obviously, and one is um, you might need fixed income, you might need something that creates income, you might need growth. All these kind of categories here are, it's nice to put it into asset classes, but that something is an alternative. Like nobody likes alternatives in the RIA space, in the wealth advisory space. People like traditional asset classes, and that is very dogmatic, right? It's not necessarily very merit based. If you're looking at the top at the top funds in the world, it's all merit based. Yes, some of them are specialized on certain asset classes, but that doesn't mean that it's asset based. Just to give you one example, if you would look at, I have this slide in here. Yeah, if you're looking at Renaissance, right? Yes, they mainly work within the S&P 500, right? So you could say like it's asset class based, but the results obviously not what the S&P 500 provides as a result, right? If you go back to January 2007, there's a difference of if you're looking at $10,000 invested in 2007 into the S&P 500, you would sit at about 4 times, a little bit more than 4 times of what you invested. If you're looking at what Medallion Fund would have done with it, it's like 85% since 2007 year over year compounding, right? And that instead of 42,000, you would sit at 186 million. I mean, it's pretty drastic once you actually have something that creates compounding returns on high levels without drawdowns. So this stuff exists. It's doable, right? But it's not happening by just investing into asset classes, right? Just by saying, okay, I'm investing into stocks, I'm investing into real estate. We could do the same thing with the REIT index. The REIT index in general, which is basically overall the real estate market, if you want, so is actually worse than the S&P 500, right? So to say like, yeah, real estate is good. And I looked at a couple of posts today just to kind of get a little bit of a sense of the messaging that is getting used. I mean, it is almost insulting, I would say, how people pitch real estate deals without any context for what actually risk really is. And I think most of the guys here have been on some of the last webinars, and I really would like one of you guys to be able to type into the chat how risk is really defined intuitively, not through a formula. I mean, we can go through that, but just like intuitively, how do you define risk? I'll also put it into the comments here on the LinkedIn thing. And I'm also wondering, that's interesting. So once I have some more people on YouTube, I can actually bring in comments from YouTube, not so much from LinkedIn for whatever reason. Okay, Jeff, I don't know if you're engaged right now. Okay, I was I was waiting for you. I was hoping that you would put it. But this is exactly correct, right? Um, so risk is basically the nice. There are some people that are paying attention. So exactly, the probability of loss weighted by the degree of that loss, right? To summarize, but he basically said that thing. Um, right, if you're looking at the S&P 500, you will see, okay, so the probability of loss is obviously there was between 2007 and 2022, there have been a couple of drawdowns, right? 2008, pretty tough. 2018, 2022, right? There have been quite some interesting scenarios with drawdowns on the S&P 500. On the Medallion Fund, there have been drawdowns, right? And there's still kind of this idea of people that high returns are related to, like, are always connected to higher risks, and that's straight out false if you have the right dynamics in place, right? So now with, like, obviously this whole idea of probability of loss weighted by the degree of that loss, that has been driving casino mathematics, if you want, so for hundreds of years. They've figured that out, and one of the big problems was obviously that it is much harder to do that math with in a scenario where you have infinite outcomes, right? Like if you go to a casino, a game has a finite amount of outcomes. If you roll a dice, it's like six different variations. If you play roulette, you have like black and red, and then two green fields or whatever. So you have like a 48% chance um, to win or lose, 52 to lose, basically, right? So the probabilities are always slightly tilted, at least towards the bank, right? And that's how casinos obviously make money, right? And that's interestingly also how in the world of finance, you don't really have to pay too much to those formulas, all those formulas in detail, but I think it's important that you know that they exist and you understand how risk in general seems to be calculated. And if you have some more deeper questions, you can connect with Swapnil, right? He's on the call here. Um, so, I mean, also with us, but he's pretty good at those things. So if you're looking at omega ratio compared to measures like, for example, Sharpe ratio, Sortino, Modigliani, all those different things, they mainly measure mean and variance, and mainly the variance, the standard deviation, right? If you're looking at omega, it's the only formula right now that basically looks at all statistical moments of risk, which obviously include, besides mean and variance, also skewness and kurtosis. Why is that important? It is important because the fat ends of the curve are where you lose your money, right? And we can do a dissertation on that, but the reality is that markets don't move on a Gaussian, and that's the assumption, right? So you have to basically look at maximum drawdowns, drawdown durations, and look at the fat tails in a sense, and not just at standard deviation, right? So the like this is one thing I think that is the most fundamental thing that needs to be understood, right? Like if you're looking at the principle, okay, so it's you at the peak, something drops down. That's the maximum drawdown, right? Is basically the amount that it drops, and then the drawdown duration is how much time. So MDDD is basically the time that it takes for an investment to come back to zero, right? We actually like to define maximum drawdown duration on our investments as how much time it takes to be back on expected return, not on zero, because nobody really wants to be back on zero. So this, I know I've shown that a couple of times, but I still believe it's worth repeating and repeating and repeating. And I'm then the CRO, whatever, the chief repeating officer. I don't care, but this is super important to understand, because why I think it's worth repeating, because everybody's getting it wrong, right? Like there's so many people in index annuities, in S&P 500 index products, and so on, that don't fully understand that the asset class in itself is not what drives the returns. It's the things that people have between their ears, the brains. Like the Renaissance has hired 250 high-end engineers, and they are driving that merit base, which basically means the only thing that matters are results, not like some religion around asset classes. I also did a poll this week asking people, okay, so they're like normally there are investors that are more merit based, and there are investors that are more on yeah, very very tied to a certain asset class. Right? There's the crypto investor, and there's the real estate investor, and there's like the VC guy and the private equity guy. Like everybody is just kind of tied to an asset class, and that is not necessarily how you will be successful. I mean, you it might make sense for some people to specialize in an asset class, but it's not the asset class. It's the strategy within that asset class that drives exceptional returns, like the ones from Renaissance. But so one of the main principles to fully understand is, and we talk to lots of people that have, for example, trading strategies, like from day trading to whatever, like a little bit more. People that build indexes, people that have like multi strategies, people that have like a combination of qualitative and quantitative analysis, and basically create like the alpha if you want. So by doing that, but it doesn't really matter what the strategy is. This principle always applies, right? Within day trading and short long or just long only or whatever. The big question is always if you backtest the strategy, or if you take the track record of the strategy that is like a real track record, the um, the probability of loss is basically how much drawdown has historically been have, did historically happen, right? What is the drawdown duration to get back to zero, and what is the drawdown duration to get back an expected return? And if people are looking at investments, they don't really look at those things over a full, at least one full or maybe two full market cycles. So if you're looking at the S&P 500, if you would have invested in whatever 1999 or whatever, right before the bust, it would have taken until 2008 roughly to get back to where it was in 2000 on the S&P 500, and then it dropped again, and then it took until 2013 to be back to really be at a point where it breaks the zero and goes upwards, right? So what does that mean? It means that for 13 years you didn't make any money, right? The maximum drawdown duration just to get to zero was 13 years. That's crazy. And if you would have put even money into a treasury bill at that point, although interest rates were like the rates and on the treasury bills were really high, you'd have made much more money compounding that over 13 years than being in the S&P 500. So there's this whole thing of Peter Mallouk, creative planning, and lots of people that have quite some voice in the space always say it's not about timing the market, it's about time in the market. And that might be true, but if you would have invested in the wrong moment into the S&P 500, and I can show you some numbers on that, your the time duration to get to 9.36% return, which is officially the expected return right now, is infinite, right? You're not getting there if you invested at the wrong moment, and the liquidity adjusted return would be about 4%, and you would need 6 years to get there if you would just invest into the index, right? So this is the most fundamental thing to understand, and you can apply that to basically every asset class. And I mean, I showed that before. This is basically real estate, right? Up to like if you invested in 1999 and just waited until 2007, I mean, everything looked great. Even if you started maybe 1995 or even whatever, right? There was a long time where everything was kind of pretty close to the rent index. It kind of went from 1983 up to 1999, basically, that rents and house prices were kind of in a pretty a nice synchronicity in a sense, and then all this kind of Larry Fink stuff happened, if you want. So, right, all the yeah, the CDOs and whatever, all these kind of debt instruments started happening, and the market became extremely inflated, and so on. But how you still want to look at it is, okay, so if you invest in the wrong moment, here obviously it would have been around 2007. The whole thing was going down until 2000 and what is it, like 12? It was still going down, right? It went pretty strong down 2009, 2010. The whole like steep drop was there. Then it kind of recovered a little bit, went further down. So it went down from 2006, 7, all the way to 2012, right? And then it started picking up again, right? So it basically took 6, 7 years to get down to the bottom, and then it took another what is it, 2018, 2019 to get back to the level of 2007. That's like 10 to 12 years, somewhere in that range, to get back to zero. And people say, yeah, that's not going to happen again. What? Really not? Who knows, right? So you at least have to, like, still, like, if you look at, okay, what is risk and how can you have a merit-based approach, you have to have some way to measure risk, and you can't really look into the future. We don't say that we can look into the future, but I think it's pretty obvious that historical events are the biggest indicator that you can use for the possibility of future event. You still can look into the future. That might happen something worse, but if something happens that is worse than 2008, we are definitely in pretty big trouble, right? So let me quickly see. Like I can't really deal with it right now. Okay, so I think, and for everyone who's kind of bored by it because I repeat it all the time, most fundamental principle is really, okay, what's the probability of loss? What's the degree of that loss through a full market cycle? What's the maximum duration that you will be in that loss? And that's the minimum that you should know in looking at any deal, without even crazy statistical capability. So if you're looking at a real estate deal, I mean, these are just kind of pulled from LinkedIn, and it was like, hey, this is the best real estate deal I've ever seen, and it might even be true. But I was thinking, okay, um, let's look at some of those things that are out there and see like what information are they really providing, and there obviously are also some rules that like that people, what you can and what you can't do in real estate. Funny enough, like people, like lots of people are kind of violating the rules all the time, and some things also it's just tolerated, right? So, but he's like, yeah, walking into 4.2 million in equity from day one. Interesting, right? So it's obviously an interesting claim to make. So the idea is, okay, this whole thing is a market value of 38, and if you have the money, you can buy it for 30 to 34, right? So what is the market value then? If you can buy it for 34, and that's one of the things that we always look at, and like it would be nice if some people would put some hack some things into the PlayStation here and interact a little bit. But what is the market value if you can buy it for 34? And how do they define how do they define the market value, right? And that they basically run into 4.2 million in equity. I mean, if the market would provide it, the person who's selling it would probably sell it for the 38, right? So there are reasons why things are getting sold for that level, and it might be obviously right now some people are upside down. The like in theory, it could be that the borrowing cost is exceeding cap rates or whatever. But in point three, they're already saying that that's not the case. The guy has actually pretty good rates. So for whatever reason, he might just need the money, right? But then if you're looking at, okay, so there's like 6% cash on cash. That's not incredibly good, and it also doesn't really seem to be. I mean, it's not bad, but it's also not incredibly good. So if you're buying it for 34 and you still have a cash on cash of 6%, I would be very skeptical that the cap rate that they're buying for is really that great, right? So, and what I'm trying to say here is if there is a $34 million price tag on an $38 million, what they believe the value is, it's a pretty cap rate condensed environment right now anyways, right? So how you would look at it is you would basically do this here for this property, right? And you would go in and say, okay, for this exact property, it's somewhat in Jacksonville, I think they said, what were the historically highest cap rates and what were the historical lowest cap rates, right? Why would you do that? It's pretty easy because if you look at the rent index, the rents are not really very volatile, right? Like it's a pretty straight line. There are some kind of little like small soft waves, but the cap rate is not changing because of like huge volatility in rental prices, right? The prices are kind of constantly going up slightly. So what drives changes in cap rates is very obviously the market prices, right? So if you have the rents pretty close to the market price on this curve here, it would basically mean that the cap rate is relatively high. And if you see this peak in 2007, this is where the cap rates would be extremely compressed. And then if you're following the chart, it actually we are again like in a pretty cap rate compressed environment, right? So that is what you look at. Okay, historically, what has been the highest cap rate, right, that you have seen at least since January 2007? And then you would most probably end up in somewhere around 2010, 2011. There might have been cap rates of 9 or 10 or 11 or whatever, even 8.5, whatever it is, right? And if you buy this whole thing at a $34 million price tag, the question is not like what the market value is right now. The question is if you buy it for $34 million and it's still a cap rate of 5 or something, and the historical highest cap rate was a cap rate of 9 or 10, then you're still exposed to a 40-50% drawdown. And you're still exposed to a drawdown duration of up to 10 years. Right? So there are other things that you can do to manage that. Obviously, cash flow is important that you could hold on for it to it forever, but with a 6% cash on cash, that's why like you could get a 3-year treasury bill for like 5.5 still, I think. Like, why would you have this 40-50% um, downside exposure for that rate? Right? That doesn't really make too much sense. And then they say like that is the biggest risk in our deal. Uh, that is not risk in the deal if the economics are planned out well enough and you know that your base basically is far below the market bottom that you have historically seen. Um, so that would basically the perspective on it. So if you go in and buy, you would rather see okay, so the highest historical cap rate was whatever, let's say 9 or whatever, and you can buy it at 7 or 8, and then you have an annualized like if you're looking at this curve here, like the bottom was not reached within like 3 months or something, right? There was a quite a strong dip between 2007 and 2010, but that was still like annualized maybe 10-15%, and then went further down over the next 2-3 years by another 10-15%. Right, so annualized the drawdown is actually not like 40% a year or something like that. It goes down at a certain level, so you have time to actually get out of it, but you have to set your base right that you can still make money or come out on expected return if you see that thing going in the wrong direction with what the market gives you. Right, this person is like if something like this happens that you have to sell, you can see it. It's like a 10% cut that he needs to take to sell it right now because he has to. Um, and probably, hopefully, that guy, if he did his work correctly, is still making some good money. Okay, so this is one of those very very interesting um, things here as well. So I just went to the Schwab platform and looked at a couple of ETFs, right? And this whole thing here in red, right? I found kind of interesting, right? Because if you would go and say, okay, I would like to do this whole exercise here, or this whole exercise here for an ETF on the Schwab platform, I would like to go back to January 2007 and see how it actually performs, right? Because I want to know exactly this year. What is the maximum drawdown? What is the maximum drawdown duration? Right? But those guys, I mean, it might have been just my lucky selection of an ETF that they created in November or whatever 2009. But I couldn't go back to January 2007. Right? You see that I put it in there, January 2007. They said like yeah, you can only go back to whatever November 2009 to check the results. But in the end, I would not want to invest into this vehicle if I can't do the whole, if I can't look at it through a full market cycle. I mean, that's one of the takeaways that I want to that I want to put out there, right? So then the next question is, obviously, we're talking about merit based. So how, like, what's actually the goal here, right? So for most people, still, if it's not like a multi-billionaire who doesn't need to worry about income in general, most people that are retiring are looking for some kind of income goal, right? So how and then like if you're looking at this whole thing, normally this number, and we talked about it before, is like 300 times whatever you need per month, and then with like a 5-6% return, you which could be like an annuity or something like that. You could basically, with 300 times your monthly income, you would basically be good in terms of net returns that you can live on, right? So if you would need like 25 grand a month, um, in 10 years or whatever, you would have to have whatever it would be, like $7 million as kind of the principal to pay for it. If you have higher returns, it obviously would be less than that. Like if you would have 10% returns, as an example, you only need 2.5 million dollars for the same amount of income, right? Or maybe 300. Sorry, about 300,000. So it would 3 million. Sorry. So if you have 10% return, you would probably need about $3 million. If you have 5 to 6% returns, you would need to have like $7 million. It's not easy for everybody to get to those high principles, but then if you start early enough and you have a high growth performing asset, you can actually, the compound effect is always on your side. But the compound effect is only on your side if you don't have drawdowns, like in the S&P 500 that we looked at. Um, and here's just one example, right? There's a global equity strategy where you see the big difference, right? If you would have invested in 2006 into the S&P 500, about $1 million, you would sit on $5 million, 344 today, just based on the results that they're posting, right? So we would have probably 5x your money, right, within 15 years, or 18 years. Is it 18 years? Yeah, that's what it is, right? Right. So that is nice, but it's not necessarily sufficient, right? If you look at a product like the one that I just chose here as a comparison that has a little bit better results, um, it has higher returns, and people always think, okay, it's higher returns, so it's also a higher risk. No, it's not, right? It has an annualized risk of 17% compared to 19% of the S&P 500, and the liquidity of expected return, as I mentioned before, on the S&P 500 is infinite. On this product, it's a 98 month, which is long enough, right? It's what would it be, like 8 years, something like that, which is long enough, right? But it's definitely better than infinite. And then if you look at the liquidity adjusted expected return, which basically means if you invested at the wrong moment into the S&P 500, what would be an expected return? It's like 4%, and the liquidity adjusted expected and the liquidity of the adjusted expected return would be 72 months, right? So within 72 months, you would be on 4%, and that you can get without any risk, right? The like fixed income instruments or treasury bills or all kinds of things where you can get 4% in 6 years without taking the risk of a 20% loss. So why would you go into an S&P 500 index, and why would you put your clients into an S&P 500 index based product? I hope that makes sense so far, right? So but then obviously there needs to be the ability to make some math, right? But it's quite interesting how the curve gets different. Like the bottom one is the S&P 500, and you know that people always show you this kind of chart where it's all going up, and that's obviously also true. But the compounding effect on something that doesn't have those drawdowns and a much higher return is so much bigger that the S&P 500 basically looks like a flat line. It is quite fascinating, right? But here you on this investment on the right side, you have one drawdown in 2018 of 7%, and everything else was like 16, 37, 38, 84, and so on, right? So it's quite stunning. And all of a sudden, instead of $5 million, you have 545 $1 million, right? So it's basically 100-fold because of the compounding effect. Why I'm saying that is because if you are still in a range where you can build growth, it makes obviously a difference how much principal you can build. So let's say you're in your 40s and you want to build within the next 15 years or 25 years how much money you will have. I mean, you rather want to be on the right side of this spreadsheet than on the left side. That's where I'm heading with it. So growth is obviously, especially during that time, extremely important, right? And if you like how we would basically calculate is that you go at those different peaks, which the peaks are always kind of, if we're going back here to this whole idea, the peaks are always kind of where things get tricky, right? Where after that it drops down, and if you accidentally invested it at the peak, is kind of where it becomes a little bit of a yeah, way basically the liquidity adjusted um, returns are more kicking in than the ones when you would invest into the right moment in time. So in other words, like if we're looking at those different peaks, and then we draw basically the trajectories if you would have invested at those different peaks, and that in the end leads to those numbers here, right? That we say, okay, this is the annualized risk, and this is the liquidity to be on that expected return. So the expected return is not based on one of those curves that are kind of the best possible scenario. Although if you see like at the outcome, the expected return that we post is even yeah, is basically a combination of these of testing the strategy through different moments and seeing what the returns would be if you would have invested at the best or the wrongest moments, um, if you want so, right? So if we're looking at these 39% expected return, there's a lot of math happening to really get to that number, right? It's not a pro forma. And then here's another example. I mean, this is a pretty special strategy, obviously, but these things are out there, but they would be categorized as most probably somewhat esoteric, and nobody would ever show to you. Once for one reason, because it's really hard to find. For the other reason, because you don't have it available through platforms like Schwab or anything. And then in the RIA space, unfortunately, people don't really want to do a lot of things that are not on the Schwab platform. Um, and if you wanted, by the way, you would need to have a partner like we work with Next Generation, which is basically like people would need a self-directed RIA, like a Roth RIA, to basically pull qualified money that is in retirement plans and those things into investments that it can accomplish something like that, right? But this is obviously pretty fascinating here. On this one, it's like a expected return is 82.83%, which is stunning. Annualized risk is only 1.97%. But yes, the liquidity of the expected return is also infinite, but on 82.83%, which is kind of like obvious, I think, to realize that if you kind of invested at a peak in that strategy and then it dropped down, it's almost impossible to kind of catch up on the compounding, right? Because if something is compounding with 82%, like once you're a couple of steps behind, it's impossible to catch up, right? But then if you're looking at the liquidity adjusted expected return, it's still 70%, and you can get that done within 46 months. It is quite crazy, right? So $1 million invested into that strategy would be over 15 years turn into 57 billion. It is crazy. Unfortunately, those strategies don't have. Not all of them have like crazy capacities, but they exist with some geniuses out there that make things like that happen. Right. So that is, I mean, there's a private equity strategy, also pretty interesting. I mean, liquidity of expected return is 48 months, zero annualized risk, 50%, yeah, 50% expected return. That compounding, and that's obviously due to those multiples you can see in 2007, 2012, and that there are like those bigger liquidity events that can happen in private equity, and even in those other years, obviously like 2023, 60%. It's quite stunning. And then if you have that obviously compounding over the years, it is quite stunning that instead of the 5 million or so that you get out of your S&P 500, you would. This was only 2007. The one before that showed the 5 million was back to 2006. This one we only tested to 2007, so it's 4.7 million S&P 500 over 15 years, 1 billion for the same million invested into something with that much growth. It is quite interesting, right? So, and then if you're looking at how to compose portfolios, the way that we would basically do it is to say, okay, so what is really the amount of income that you need? That goes into like if there's no income yet, nothing goes into the income product. And then if there is a product, it all goes into the growth. And then you basically, like the way that we do it is we just have a portfolio there of strategies like the ones that we showed, and basically take the portfolio so that we can effectively guarantee a 24%, 24 to 25% return rate, like completely without drawdowns. And that goes into the growth. And then once you start needing income, you would basically move things into the income, right? But on the left side, it's basically the historical performance, and then you would go into the the annuity. Obviously, historical is whatever the coupon is, and yeah, people might say, okay, this is what I need in cash reserves, but this is how you would construct it, right? So, but to sum things up, and I will send you guys into the weekend. Um, I think one of the most important things is all the things that I just showed are completely different asset classes. Don't like it's all about merit. It's not about asset classes. The only thing that should matter are the results, and the results should be measured with those three things, right? It's okay. What is the drawdown risk? What is the drawdown duration? What is the expected return through a full market cycle measured? Also, there's this one thing that is kind of interesting that I feel also is, I mean, it's also true in other parts of life, if you want. So if you, it's kind of interesting. I've hired over my career a couple of hundred, maybe thousand people in different environments, but definitely a couple of hundred. And over the time, you learn how to ask questions to really kind of see how predict how people might behave. Right, and with investments, it's kind of a similar thing. You try to predict how that investment might behave, right? But if you would go and you ask someone that you hire for a management position, okay, you give them a scenario and say like, this or that happens on your team, and one of your team members would do a certain thing that you don't want them to do. Like, how would you handle it, right? And they're saying, and you give them a chance to describe how they would basically handle that in the future. You get a very like you get very nice responses that sound smart and all those things. But if you take the whole question but ask it in a different way, and you would say, okay, have you ever had a team member that did those or those things, right? And probably they had, right? And otherwise you will ask for some other things. But if somebody's really experienced in management, you have team members that were not really doing the things that would have been helpful, right? And you ask, okay, so how did you handle that situation, right? And then you would potentially even say like, okay, if could you give me in front of the interview, before the interview, could you give me a couple of contacts of subordinates and superiors that you've worked with in your last job, and that I could just call them and confirm a couple of things, a little bit of truth serum in a sense, and then you would ask them, okay, so how did you handle that situation? And if I would call that person, what would he tell me about you? All of a sudden, like the real thing comes to the surface, and it might also not be necessarily bad, but the response that you get if you ask someone, what would you do if you run into that situation, was very different from what they did most of the time. And the things that they did might not have been perfect, but they're probably relatively human and understandable, and you know much more about that person than with their kind of made up story of what they would do. And the same is true with performance and investments, right? You want to go back and say, okay, so what did this investment do? Or especially during the times that are not that great, and how did it come out of it? And probably it will do relatively well if something bad happens again. Do you know exactly what's going to happen in the future that's going to be bad? Probably not, right? But those principles, obviously there can be some very sophisticated math to do those things properly. With the more complicated the asset class, the tougher it gets to kind of measure those things. But the rule should also be, if I can't measure it, I don't invest, right? Like that's one of the reasons why we're not really in crypto, because it's not that we don't believe that crypto is an asset class that you can make money with, but like our yeah, the merits that we use to measure the risk and the potential of an investment can't be applied to that space right now, because it didn't exist through a full market cycle. Like most trading platforms in crypto started in like 2011, 2012. There might have been like one cycle that we just went through, but who knows? I would rather like to see like a full market cycle. It seems to be extremely correlated right now with the S&P 500, anyways, or with the even more with the Nasdaq, right? So anyway, so you might look into those things, but yeah, the three things that you really look at and nothing else is not what asset class. Like real estate is not better or worse than any other asset class. Private equity is not better or worse than real estate necessarily, or private or public equities. Public equities are not better or worse, right? Like all those things are not better or worse. None of them. It's purely merit based. Having the skill to look at a strategy or a deal and say, okay, this is a good deal or not, based on things that you can, yeah, that you can really confidently measure. Right? And there might be people that disagree with that. Um, I don't really care too much. Uh, like everybody has its own way of doing things, but for me, that's just like the most logical and controllable thing, that you say, okay, I can't look into the future, but at least I can account for the worst case scenario that we have seen in recent history. And recent history, I would say like one, if possible, two market cycles. And because nobody else is doing that, literally most people are not doing that. They're going back like 5, 6, 7 years. You will definitely be better prepared than anyone else. Does it protect you from something super crazy happening? Maybe not, right? But who knows? Because black swans are black swans because nobody can predict them. We can't predict them. You can't predict them. But if black swans happen and you have prepared for the last black swan, um, you're probably better prepared than someone who doesn't even prepare for that. I think that's the big takeaway. But you also need some tools, right? And if you're looking at Warren Buffett, for example, he hates alternatives. I think that's also not smart. He's also doing a lot in the alternative space with like his sub companies and so on. So he might hate it personally, but his firm is doing things. But it's not about the asset class, right? He hates, like what he hated, and I can follow that, is that in private equity, like this kind of religion around EBITDA and kind of EBITDA multiples, it doesn't really make a whole lot of sense to to basically invest that way as a value investor, because like it's the wrong measuring stick, if you want. So on the other side, it's obviously gives you an indicator of like what the market value of a private equity company would be. The same thing obviously applies that we have been talking about here on on the S&P 500 or like the real estate. The same thing applies to private equity, right? You just go and say, okay, what are the EBITDA multiples? How do you grade a company? What are the kind of check boxes that you need to, like you would do on a piece of real estate? You look at like whatever in real estate. You look at location. You look at the quality of the finishings. You look at all kinds of different things. So you look at comparisons in the same area and say, okay, what is the market? What is the market price? And then you look at what is historically the worst market price for something like that in a similar area. You do the same thing with private equity. How do you rate it, right? And then like instead of finishings, there might be some other things. It's probably related to EBITDA, but the EBITDA multiple might be more on the exit side that you're worried about, and on the purchase side, you would probably more look towards, okay, what are the efficiency gains, and what is the potential for roll-ups, and what is the potential to bolt on other companies that would add value and kind of create more market share and make things more efficient. And in the end, how can you increase earnings, right? The same as in real estate. How can you get a net operating income up? Because the cap rate is driven by the net operating income. It's the same equation in private equity. The EBITDA multiples are in the end driven by your earnings, and then you have a multiple of those earnings. Very, very similar. You can apply the same model here, and as you saw on the private equity strategy that I put out as an example, which one was this one here? It's like 50% return over that time frame based on the same model. You basically make the money on the purchase, but where you set your base and you see, okay, these were the lowest multiples, these were the highest multiples, and you can basically make money with that. I think for today, I I'm done with everything that I've prepared. It was a little bit more kind of, I don't know, intuitively driven. Let's put it like this. I hope there were some insights that made it worthwhile to chime in on this Friday afternoon. I will go and get my kids and maybe go to a water park or at least go hiking or something like that. And yeah, see you guys next week. Thank you very much for joining, and have a good weekend.